Will the saying, as goes January, so goes the year, apply to 2015? I'm joined by Howard Silverblatt, Senior Index Analyst at S&P Dow Jones Indices. Howard, the S&P 500 is down just about 0.5% for the year, with about a week and a half of trading in 2015 behind us. So what's the takeaway from trading so far in the new year?
Well, it's been a bit more volatile than we had anticipated. The year's opened on higher volume, which was expected after a slow late December, even though there were some declines there. But the volatility, the intraday high versus low, has increased to a little, averaging about 1.2, 1.3% a day. So the ups and downs we're feeling more. Historically, to put that in perspective, that's still a little bit shy of the 1.4% average and nowhere near the 2.5% we were seeing in the October time period. So volatility's picked up, volume's picked up, but earnings season is just starting, and that's going to be the big determinant going, at least for January at this point in time, even as oil continues to slide.
So at this point, do you believe this saying will apply? Where do you believe stocks are headed?
Well, as January goes, so goes the year is correct. 72% of the time. That said, last January we were down 3.56% and the index ended up 11.4%, so it didn't work on there. But 72% of the time on a statistic that really shouldn't matter as much. I mean, January is important, it's the opening of the year, but it's a long year. You've got 11 months of events, situations, and financials ahead of you. But 72%, so yes, I do put some credence in it, even though the logic behind it is not as strong as analytically as we would want it to be.
Well, so that being said, so far, retail is up for the beginning of 2015. Financials are down, energy is down. Of course, oil continues to make lows. So what sectors do you predict will be hottest this year?
Well, at least as going into the earnings season where we stand right now. Healthcare obviously is an important one. They're going to have over a double-digit increase in sales, which is very unusual. Year over year, the index is just looking for a little over 4%. Their sales have been increasing, and it's mostly because there's more people covered directly by employers, as well as to Obamacare. Their margins have been cut because even though it's a generous and uncle that's paying for a lot of the additional sales, the margins have been cut and the reimbursements. But overall, healthcare has done well. They've done well last year. They're doing well this year. They're outperforming, and the earnings are supposed to do much better. Industrials are a little bit more tricky on here because of the dollar. The dollar will help and hurt depending upon how much was physically spent and done for this specific quarter. Industrials, a big part of it is going to be going forward. How is the dollar going to impact them? How much fewer sales may they have because the dollar is so much more expensive as compared to how much they're producing there. So that's going to be a very volatile. But the one that's going to open up everything, obviously, is financials. Looking for about a 5% increase overall on financials. The comparables for last year are not that difficult. So we should see a beat, but the question is by how much. Wednesday starts the big banks. We've got JP Morgan, Wells Fargo, then you've got Bank of America and Citi on Thursday. So we're going to have a big part of this, and investors really need to look at those numbers because, yes, it'll be a beat, but the problem is how did they do it? How much were the legal expenses that they're still incurring on there? How much was new loans, which have been very slow to materialize, and the profit margins are lower on there. So again, the stats are going to tell a different story than the top line in this case for the financials.
Absolutely key things to watch. Thank you so much, Howard Silverblatt, Senior Index Analyst at S&P Dow Jones Indices. And I'm Brittany Umar for The Street.